Welcome back to Around the Table with Stacy Smith. We're talking about the economy and investing. And as you know, 2022 was not a good year for either stocks or bonds. But recently, it seems investing in bonds is on the uptick. The markets are also been up so far for the year. But as the Fed raises interest rates, those high rates are reflected in what a bond pays in interest. So, Frank, my question to you is now a good time to try to get into bonds?
Bonds are a leveling device that investment managers use to try to keep portfolios from being as volatile as the equity markets. And normally that works. Last year it didn't work at all. Last year bonds might have been more volatile than stocks, or at least very volatile. And that happened also in the late 70s and early 80s. So in my 50 years plus of doing this, it's happened in a big way twice. And normally, and I think we're going back to normally, bonds should represent a percentage of your total portfolio, depending on what your goals and objectives are. Everybody throws around 60-40. I'm not so tied to that. I think every individual needs to create their own thing. It used to be back in the days everybody was trying to make it into math, that they said if you were 70, you should have 70% of your money in bonds. I don't buy that. I don't think it's that simple. I don't think any of it's that simple. But bonds, yes, have become a better investment now that interest rates have risen. Are they not going to go down? You tell me what interest rates are going to do, because if interest rates continue to go up, bonds will go down. It's math. And if the economy goes into a recession, that lower quality bonds will go down because they will be a higher credit risk than treasury bonds, for example.
So when you say go down, I just want to interrupt for a second, Frank. You mean the price of the bond goes down?
Correct. Correct.
As the interest rate goes up.
Right.
Because they're inversely related.
Right. And what a bond investor needs to determine is how much risk, just like an equity investor, he wants to take. If he wants to take no risk, then that theoretically is in the treasury market. If he wants to take small risk in high quality corporate bonds, that is there, and municipals, which municipals are an income tax issue as well. And so bonds are a very, I think, simple investment vehicle. For some reason, when I talk to people, their eyes glaze over when we start talking about bonds, because we're not talking about it going up or down. We're talking about paying interest. And that's why you own it, for the cash flow. And if the cash flow is secure, it'll mature at par.
There was an interview where the interviewee used a phrase that I liked. She said, the Fed, by raising rates, has put income back in the phrase fixed income. And for that reason alone, in addition to the balancing, why wouldn't you, if you can get decent income from bonds and you're not going to try to play the bond market, buy good quality bonds and collect an income which you can use to reinvest or to live? That's a good reason.
But the issue becomes, I'm sorry if I'm interrupting before Carrie or Kim has a chance to talk here, but the issue becomes what we faced last year. And again, it's a rare occasion, and that is that we saw the price of the bond go down from what people perhaps bought it for. And at the same time, other bonds, newer bonds, their yield was going up, their price was going down. So it does become a problem.
That's why you manage maturities. I'm going to preempt. I'm sorry. That's why you manage maturities. You don't go out long, so you don't have to worry about the fluctuation. You have a fail-safe of a maturity date. I'm sorry, Kim.
That's okay. I'm just going back to the very beginning premise. Whenever people hear stocks and bonds, they don't really get a grasp. A newer investor doesn't understand what is the difference. Here's the thing. Bonds, you are the bank allowing somebody to borrow money from you. And the only thing you care about is getting that money back, right? And that would be like if you lent somebody $10,000, you want $10,000 back at some point in the future. What stocks are, you're an owner of a company and the value is going to go up and down. And it's really difficult to calculate what the intrinsic value of that holding is every day. And that's what the market does. And theoretically, that's why bonds should be slower, because all you're trying to do is wait out, somebody's paying you interest for borrowing your money. The crazy thing happened last year when the interest rates went up so quickly that to comprehend the difference between the value of your bond just sitting there waiting for it, the price of that bond had to go down, even though your $10,000, you're going to get the 10, if you lend 10,000, you're getting 10,000 back. It is really just that easy. And I'm going to drop out of the conversation now.
I so agree with what Frank said. Like, this is so easy, but it's like, it's hard for people to grasp, and I'm going to make it even more complex. We know interest rates are going up, the Fed has basically said that, but yet the bond market is up almost 3% this year. So it is important to discern the difference between the rate that the Federal Reserve sets and what the market sets. So even though the Fed is still raising rates in the short term, the bond market is telling us that they're raising too quickly, and the bond market is predicting this recession. So, it gets tricky to be able to figure out at what point, okay, rates have gone up, but have they gone too far? And I think what the bond market is telling us right now is that, yes, if the Fed continues to raise rates, it's going to slow the economy, and eventually we'll see rates come back down.
Right.
But I am right there with Frank. I mean, we've always invested in them. We will always invest in them. We understand that you're going to have bad years with bonds, and last year was the worst that we've all experienced. And I know that Frank and Bob, have
Speak
been
for yourself,
around. They
kid.
keep telling
Speak for
me they've
yourself,
been
kid.
around
We saw
so
it the
long.
last time.
Yeah, but that wasn't 1 year. That took years to be bad.
Yeah.
Yeah.
Right.
We have to take a break. We'll
So-
be back in just a moment. Thanks.